Today, I'm sharing one of the most powerful wealth accumulating techniques that's used by the major stockbrokers and hedge funds. Welcome to the Live and Ascend YouTube channel, where knowledge is liberating. Today, I will be showing you in detail what dollar cost averaging and buying the dip is all about. To master this technique, you need to watch this video from the very beginning to the very end. Rewind and play this again if you miss anything. I promise you, it's all here. And at the same time, how to increase your wealth and investment portfolio. You will see how applying these two methods can create a powerful long-term and short-term strategy to help you reach FIRE, financial independence, and retire early, and keep you there. To learn the inside scoop on FIRE, watch my video titled Financial Independence. Let's proceed to take a look at how these things actually work and how it will more than triple your investment income by the time the next economic boom occurs. So you may be asking, what is a dip? What is dollar cost averaging? And how do I strategically use them both? I will show you this in a bit, but there is a short list of events that happened in 2020 that I need you to always remember. This will help you to gauge when the perfect time is to accelerate your investing, meaning the amount you are putting into your brokerage account and the frequency as well. You will be able to do this without the need to do any overwhelming price movement and technical analysis. Paralysis through analysis is a real issue that causes many investors to miss opportunities. I don't want this to happen to anyone that is subscribed to my channel. Let's begin. The last economic boom occurred in 2020 during a time of uncertainty and lockdowns. Many individuals didn't see the opportunities that was there unfolding right before their very eyes. The sitting president had issued emergency relief funds in order to help the United States citizens continue to maintain and pay for their daily living expenses. The check amounts that was issued was greater than what many individuals were receiving per month while working at their regular 9-to-5s. Many decided to invest those amounts into stocks and crypto, causing the fastest growth and rebounding of the financial markets, which includes real estate. These markets were growing and excelling at a record pace financially, primarily through two stock trading vehicles called ETFs and mutual funds. To learn more about these vehicles, watch my video titled ETFs versus mutual funds and learn how they work in more detail. Let's continue. The stock market chart I provide shows the downfall of the S&P 500 of 2020. As you may or may not know, the S&P 500 is a major indicator of the top US companies. You will see that in a matter of 6 days, March 19th to the 25th, during the occurrence of the global crisis, the stock started to rebound and shot to the moon. This V-shaped pattern movement is called a dip. It occurs when the price of stocks, ETFs, mutual funds, and options shoots down, then bounces back up. This provides an opportunity to buy strong companies at a discount and making a profit as the underlying asset moves to new record highs. The opportunity to create and acquire wealth is rooted in these movements. These movements have made many long and short-term investors very wealthy and have strengthened the retirement 401k and IRA portfolios of many alike. In order for the average everyday person to get a piece of the wealth pie, the strategy of DCA was created. DCA stands for dollar cost averaging. Dollar cost averaging is the process of putting in a fixed amount each month or week based on your extra spendable income. Dollar cost averaging is a more conservative approach to investing than simply spending all of your money on security at once. This technique allows investors to commit to a fixed dollar amount of a particular investment on a regular schedule regardless of the share price. Ultimately, more shares will be bought when prices are lower and fewer shares will be bought when prices are higher, resulting in a lower average cost per share. Dollar cost averaging reduces risk by allowing investors to ease into the market over time. If you have a 401k plan, an employee can select a predetermined amount of their salary that they wish to invest in a mutual or index fund. When an employee receives their pay, the amount the employee has chosen to contribute to the 401k is invested in their investment choices. Let me demonstrate to you how this combined strategy works. In this example, I purchased $200 worth of stock in John Home Cooking Restaurant for each month for 4 months. In January, the value of the shares dropped to $50. so I buy 4. In February, the stock is worth $40, so I buy 5. In March and April, I buy 8 shares of John's Restaurant, which dropped in price to $25 each. Overall, my purchase of 25 shares ended up with an average price of $32 per share. If I had invested all of my money at the same time, then I would have only bought 16 shares for an average price of $50 per share. As the shares that I currently have increase in value, so will my profits. This is the best and safest way to buy low and sell high. Feel free to rewind and play this video again. Also, you may want to watch more supporting videos on this channel. I hope this helped. Take care.